Welcome to the Daily Consolidation, your 15-minute briefing on today's market action. We break down the day's most important moves on Wall Street, delivered right after the closing bell. Please note, this is an AI-generated podcast, and the views shared here are for educational and informational purposes only. Nothing we discuss should be considered personalized financial advice. Always do your own research and consult with a qualified financial professional before making any investment decisions. Now let's dive in.
Today was one of those days where the signals were just all over the place. Really one of the most confusing I think we've seen all year.
Completely.
I mean, you see the headline, right? The Dow Jones Industrial Average crossed the historic 48,000 mark.
For the first time ever. It's a huge number, closing up, 0.68% at 48,254.82?
Exactly. And that's the 16th record close of 2025. So on the surface, it looks like a celebration.
It does, but that's where the good news kind of stopped. If you looked just beyond the Dow, the S&P 500 was basically flat.
Barely moved, up just 0.06%. And the tech-heavy NASDAQ actually finished down minus 0.26%.
And that divergence, that's the whole story today, isn't it?
It is. This was a classic, and I mean aggressive, sector rotation day.
So you're saying capital was just rushing out of those expensive, high-flying tech names?
And flooding right into classic value and cyclical stocks. We're seeing a fundamental shift in what investors are willing to pay for.
Yeah.
I have to say, my own screen felt totally disjointed.
So this rally was really, really selective.
Extremely. It confirms that this broad AI infrastructure thesis is really facing some scrutiny now. Investors are starting to draw a line in the sand.
A line between who?
Between the companies with the foundational tech and, well, everyone else. They're favoring financials, healthcare, industrials, the traditional businesses with visible, predictable earnings.
Not just abstract growth projection.
Exactly. And, when you're hitting historic record highs, you really want to see the whole market participating, right?
Right. You want that broad conviction, and we just didn't get that.
No, and the technical signals were muted too. Trading volume was extremely light. We're talking 15.3 billion shares.
Which is way below the average.
Way below. The 20-day average is 20.8 billion. Hitting a record on light volume like that can definitely raise a yellow flag about the sustainability of the move.
So if tech wasn't driving the bus and the volume was weak, what was the actual fuel for the Dow's surge today?
There was one major, undeniable catalyst that brought a sense of stability back.
The government shutdown.
The Senate passed the funding legislation to finally end this 42-day shutdown. It still needs a House vote, but the odds are high it'll pass.
And that optimism just flowed directly into the sectors that benefit from stability.
Right, precisely. Healthcare, consumer staples, and especially financials. They all had a great day.
Okay, so that explains the Dow's strength. But here's where it gets really weird. The cross-asset signals were, completely schizophrenic.
A day of pure paradoxes. Just look at the energy space.
Yeah, that was wild.
WTI crude oil absolutely plunged. A massive 4.29% drop.
Down to what, $58 a barrel?
$58.42. Now, historically, an oil collapse like that screams fear about global growth. It should pressure stocks.
But it didn't. The energy stocks actually went up.
Paradoxically, the energy sector gained 1.3%.
So why the contradiction? If the commodity is crashing, why are the stocks rallying?
It's all about that aggressive technical rotation. Think about it. There was heavy, forced selling in those mega-cap tech funds. Portfolio managers had to park that cash somewhere, and fast.
And they just chose cyclicals, which includes energy.
Exactly. It's less about being bullish on the price of oil and more about just finding a relative value spot outside of tech.
And then there's the safe haven trade, which was just as confusing.
Gold rallied a substantial 1.66%.
To over $41.95 an ounce.
Now, gold is your classic I'm scared trade, right?
Right. But it rallied on the same day the Dow hit a record high, which is supposed to be a signal of confidence.
It tells you investors are trying to have it both ways. They're positioning for stability, which helps those Dow cyclicals, and for high uncertainty, which drives people to gold. It's a massive contradiction in flows.
I think the biggest irony was in the tech world itself. You had AMD's CEO, Lisa Su, come out with this wildly bullish forecast.
Oh, it was huge. 35% annual revenue growth over the next 3 to 5 years. AMD surged 9% in the pre-market on that news.
And yet the NASDAQ still finished lower.
And that is the clearest signal you'll get that the rising tide lifts all boats idea is, for now, dead.
It's a stock picker's market.
Absolutely. Investors are in a show me the money mode. They'll reward a leader like AMD for concrete guidance, but they're punishing the broader tech complex over valuation concerns.
Okay, so let's drill down on that. Capital was flowing out of the big tech ETF, the XLK. Where specifically did it go in the Dow?
The leadership was really concentrated in two areas, financials and healthcare.
And financials had a stellar day.
They did. We saw Goldman Sachs, Morgan Stanley, JP Morgan, all of them hitting 52-week highs. That shows real comfort with credit and stability.
And healthcare.
Also a huge driver. Merck was a standout, climbing 4.8%.
And looking at individual stocks, it seems like that same theme played out, rewarding concrete results.
For sure. You saw a name like On Holding, the ticker is ONON, up 8% after they raised guidance again.
For the third time this year, right?
The third consecutive quarter. That's just strong, consistent performance. And then you had pure M&A stories. Bill Holdings surged 12% on reports that they might be for sale.
And Clearwater Analytics was another one, up 9% on similar news.
Right. So these are clear, specific catalysts being rewarded, not just some abstract projection about what might happen 5 years from now.
Okay, so that's the equity market story. It's saying confidence, but be selective. But to get the full picture, you have to look at the bond market, which often tells a more sobering story.
And it certainly did today. It was complete counter-narrative. The 10-year Treasury yield actually fell 5 basis points.
Down to 4.08%. So bond investors are seeing something different.
They seem much more focused on weakening labor data, like some of those recent ADP job cut numbers. So you've got this split. Equity investors are cheering the shutdown ending, while bond investors are worried about jobs.
And does that Treasury rally mean the market is getting more convinced about a Fed rate cut?
It definitely reflects a growing conviction that the Fed might deliver a cut in December. The bond market has an easing bias right now, even though Fed Chair Powell has been very cautious in his language.
What about credit conditions? That's always a good gauge of systemic risk.
Well, investment-grade corporate bond spreads are still remarkably tight. They're sitting around 70 to 75 basis points over treasuries.
And that's really compressed, historically.
It's near the tightest levels we've seen since the late 1990s. It suggests the big money investors are very comfortable taking on credit risk right now.
Let's touch on real estate for a second. We know mortgage rates are easing a bit. Is that helping demand?
It is not. The 30-year fixed is down to around 6.12%. But that relief isn't moving the needle on demand at all.
Because of this lock-in effect we keep hearing about.
Exactly. It's a huge deal. Think about it. Over 80% of current homeowners have a mortgage rate below 5%.
So if they move, they have to give up that incredible rate.
And buy their next house at over 6%, their monthly payment would skyrocket. It's like they're wearing mortgage handcuffs.
And the data shows that.
It's staggering. Only 2.8% of U.S. homes changed hands in 2025. That is the lowest turnover rate in at least 30 years.
Wow. Okay, now let's pivot to the assets that are most sensitive to pure risk and fear. I'm talking about crude oil and crypto. What are they telling us?
They are screaming caution, not confidence. That 4% plunge in crude was driven by pure bearish fundamentals.
This wasn't just noise.
No. The main drivers were China's slowing demand growth, now down to 2%, and a surprisingly big 5.2 million barrel build in U.S. inventories. It's a clear supply-demand problem.
And gold's move up seems tied to that same instability.
Precisely. That 1.66% rally was supported by huge central bank buying. We're talking 220 tons in the third quarter alone.
So the big institutions are positioning for something the Dow isn't seeing.
It seems that way. But the real fear was visible in crypto. The sentiment gauges hit levels we haven't seen in a long time.
I saw that Bitcoin fell below that key psychological level.
Yep, down 2.3%, below $105,000, and Ethereum got hit even harder, down 4.3%.
And the sentiment index?
The crypto fear and greed index just collapsed at 24. That officially marks extreme fear territory, a level we have not seen since way back in early 2024.
That sounds like retail investors are panicking and selling.
It does look like capitulation.
Yeah.
But, and this is fascinating, the flow data told a different story today.
There was a contradiction there, too.
A big one. Despite the fear, Tuesday saw a sharp reversal, with $533 million of inflows into Bitcoin ETFs.
So the institutions might be buying while the retail crowd is selling.
It suggests potential institutional accumulation. And historically, that's a pattern you sometimes see near a medium-term bottom.
Okay, so given all this complexity, the Dow's rally, the bond market's worry, crypto's fear, what does it all mean for tomorrow? What are we watching?
Tomorrow is absolutely crucial. We finally get the October CPI and core CPI data.
Which was delayed by the shutdown.
Delayed, which makes it even more important for figuring out inflation and what the Fed might do next. An upside surprise there could completely flip the script on that December rate cut narrative.
And any big earnings we should have on our radar?
The main event is next week. NVIDIA reports on November 19th. That will be seen as a proxy for the entire AI investment theme.
A real bellwether for the market's biggest story this year. And what about technical levels?
Well, market participants are watching to see if the S&P 500 can hold support around that 6,650 to 6,660 level. That's its 50-day moving average.
And for crypto?
Bitcoin really needs to reclaim that $105,000 level to stabilize things and get that sentiment gauge out of extreme fear.
You know, given this intense cross-asset contradiction, the Dow celebrating a record high while the crypto fear and greed index is signaling extreme terror, it really raises a big question. Is the market's optimism confined to just a few old economy leaders, or is this extreme fear in assets like Bitcoin and oil actually foreshadowing a broader growth scare that the Dow just hasn't acknowledged yet? Something for you to ponder as we await tomorrow's CPI release.
That's all for today's episode of the Daily Consolidation. For more daily market analysis, subscribe and we'll see you at the next close.